So there are many casualties from Trump's trade war. US jobs are a big one. Now we have seen massive revisions down as well as payroll cuts almost every single month. Meanwhile, it seems that the economy is breaking down again. Moody's analysis just gave us quite a shocking revelation, and better strap yourselves in for this one. Now, a third of US states are already in a recession. They used the same calculations and figured states including New Jersey and Illinois, they are contracting hard. People are losing jobs there and spending is starting to crater quite badly. It's very horrific for the Rust Belt states, those focused on industries and even farming as well. The tariff effects are hitting almost everyone. Should Trump escalate things, we could see more of this map turn red and not in a good way. And this is just one micro effect of the mess we are in. However, on a global scale, countries are moving away from US currency in a massive way. Investors doing it is one thing. Me and you dumping dollars for gold is important. However, it's not the full story. Now, the big swings, the real seismic events happen when global economies start to change their patterns. The era of relying on dollar funding is starting to melt away. Countries looking to borrow money are now looking towards the Chinese currency, the RMB. The usual method is to issue US dollar debt to raise funds in the reserve currency. That was the traditional way. That is the go-to method for many smaller and emerging market economies. But we are witnessing a big shift away from good old tradition. Hungary is looking to finance their railways and car factories in China. They are looking for investors to pile on the cash, which means issuing RMB bonds. Kenya and Kazakhstan are also moving to raise money in Chinese markets. A state oil producer there is going to raise funds in the RMB and not dollars. Now, all of these moves tells us one thing. The global euro dollar market is starting to crack. Countries are looking towards Chinese investors and Chinese money to raise funds. The amount of RMB borrowing from emerging markets is almost 5 times higher this year than in 2024. Nations are beginning to grab Chinese money now, especially when the dollar is in crisis mode. And this is being done in a variety of ways. Panda bonds, which are RMB debt issued within China itself, dim sum bonds, which are yuan denominated debt sold to foreigners outside of China. And Kenya, for example, is also talking about converting their dollar debt to the Chinese yuan. This is a big step and there are big underlying reasons why. Now, firstly, let's talk about the dollar strength. If you are in the US, a falling dollar obviously isn't great for you. Imports cost more, and your trip to Walmart gets more expensive. Now, as a foreign country or company, borrowing money in dollars also poses the same problem. If you issue $1 million loan today and 12 months later the dollar collapses, you're left with a hot potato, especially when you are borrowing money to spend it elsewhere. The dollar today is down by almost 10%, and that isn't funny. It means if you borrowed $1 million, it now has purchasing power of just 900 grand. Not only must you pay interest on your dollar debt, now you can buy less with it. So really, your cost of carry or borrowing is at least 15%. And as a company or country, you have a big dilemma here. Do you dare hold on to your dollars for a good opportunity, just sit and wait? Or do you just spend it right here, right now because the clock is ticking? Not a good position you want to be in. And the story gets worse. We are just a few days away from the Fed rate cuts, which are near guaranteed. And with the jobs collapse, Powell needs to do something. Furthermore, we have Bessent confirming Trump wants massive rate cuts. He's branding it as makeup cuts, which kind of signals a 50 basis point slash could be coming really soon.
If the Fed says they're data dependent and the data has been atrocious, then it seems like there's probably some makeup cuts in order here, or the size of this month's cut needs to be recalibrated. And sure, it could be fixed. Anything can be fixed. You just have to first, we had to establish that it was broken, which President Trump did. Now we have to go about fixing it.
Now we know the drill, don't we? When rate cuts come, the strength of the dollar will likely fall. Another 5 to 10% drop over the next year is entirely possible. The faster the Fed cuts, the more aggressive they get, the faster the decline of the dollar. Meanwhile, it's just smarter to borrow in a Chinese currency. The RMB is more stable than the dollar, especially when the world needs to buy stuff from China. Now, borrowing costs are also extremely cheap compared to US rates. They are worlds apart. National and corporate borrowers can lock in a rate at only 2.4% if they borrow in the RMB, and that's half the rate versus dollar denominated debt. And you're borrowing in a currency that is more stable than the dollar. So it's a double positive for countries or companies looking to raise cash to spend. Even countries like Kenya are swapping their dollar debt into yuan to cut interest rates by half. And that's how big the shift is starting to begin. China really isn't doing anything here, guys. It's Trump's trade war that is triggering this big move. And maybe that's why Bessent is now scrambling to meet China for yet another round of trade talks with them. And this time he's heading all the way to Europe, flying all the way to Spain. Now, the talks with China are going to cover economic and trade issues. The agenda also covers TikTok, which is a very big stumbling block that is still unresolved. And after that, Bessent will be flying to London to meet the British government. And we can probably guess what demands will be flying around. It's another roundup of US allies to kiss the ring. Now, Bessent is going to meet China during a very difficult period. Trump is on the verge of imposing a 100% secondary tariff on China for buying Russian oil. Now, as we know, that is a crazy proposition. The desperation to end the war is driving the US to initiate a bigger confrontation with an even bigger economic giant that is also a nuclear power. Now, a key challenge Bessent faces is trying to keep inflation at bay, and it's going to be a tough sell when you are trying to punish China at the same time. Now, the overall CPI has risen by 0.4% in August, and that's the most since the start of the year 2025. It's as if we are back in the Biden administration when inflation was a problem. Now, the tariffs are starting to take effect, and Bessent knows it's just going to get worse. Just wait till rates come down and the dollar takes another dive down. And here's the question: can he piss off China at this point in time? The US still relies on a lot of Chinese imports. Everything from smartphones to chemicals to electronics, even tractors to power the US economy. And if you raise tariffs all the way to the sky, consumers, what will they do? They will just collapse. Now, will this deal a major blow to China? Not really. Now, we have mentioned many times how China has managed to shift their exports beyond US markets. So, Trump's threat at this point really doesn't have much of a bite. And the data tells us everything. Chinese exports to the US fell by 33% last month. Now, sure, that sounds horrific, but US exports to China also fell by 16%. Consumers there are bringing in less American products, so it is a tit for tat. However, China's shipments to Europe, Southeast Asia, and Africa flew to the moon. They were up by over 20% on average, and Beijing is ready for battle of attrition if needed. Chinese exports to the US might grind to a halt, but don't forget, US exporters will also face punishments, and that's almost a guarantee. But China has more outlets to shift their supply to, and this is the critical difference. Now, the game of geopolitics is all about leverage. Who has the advantage? Now, the US, of course, uses tariffs, sanctions, and the dollar as bargaining chips. But China has the edge when it comes to supply chains. And we best believe Bessent will talk to the Chinese about relaxing their rare earth controls to an even greater degree. China is sending supply to the US, but this can always be turned off in a heartbeat. Now, back in July, the Pentagon cooked up a really bizarre plan to reshore their rare earths production. They poured money into a US rare earth producer for a certain type of supply called neodymium praseodymium. It's highly needed in the defense industry. And here's how ridiculous it is. The Department of Defense set a guaranteed floor price of $110 when the market price was recently at $60 a kilo. So no matter what, the DoD, you have to spend 110 to buy it, which means taxpayer money is being spent to subsidize expensive rare earth supply. And this is the exact opposite of free markets. US supply is nearly double that of China's production, and there's no way you can keep this up forever. It also gives China a lot of leverage to play around with supply and demand to hammer the US. Now, all it takes is for China to flood the world with rare earths to squeeze the US government dry. Will Trump continue throwing money into the black hole? But if he doesn't, US rare earth producers won't be able to survive. So you cannot reverse decades of neglect with such gimmicks, it just won't work. China controls 80 to 85% of the global rare earth oxide production. Now, the US might have 5% or so, but these are highly expensive supplies. And as we mentioned before, they are probably double the cost versus Chinese miners. And if things get nasty and the talks break down in Spain, Beijing always holds this trump card over Trump, pun intended. And should they do a rug pull like back in June, many US industries could face total shutdown. Another industry China has the US by the neck is farming and agriculture. And just like energy imports, China is shunning away from US soybeans. They aren't buying any because of this trade war. US farmers themselves are really facing a big squeeze that is pushing them towards collapse. And this admission is very startling.
1 in every 4 rows of soybeans in every field in the entire United States of America has to go abroad. China is the largest importer of soybeans in the world. They import 61% of the world's market. Last year, we sent around $12 billion, I think $14 billion worth of soybeans the year before. For the first time in 20 years, China's bought 0 soybeans and 0 new crop corn out of this country.
0?
So we went from 12 billion to 0.
Where are they buying the soybeans?
Brazil.
Which brings us to a very serious question. What leverage does Scott Bessent, our best friend, have in the talks with China? Now, he can't threaten Beijing with higher tariffs because they can survive indefinitely. Things will boomerang back and drive US inflation even higher. So the most obvious solution is to form another coalition with the G7 to blockade or sanction China as a group. And one can assume Bessent's trip to the UK might be to discuss such a measure. After all, the US has some leverage there. OpenAI and Nvidia are about to invest billions of dollars in the UK. They're going to open more data centers there. The timing definitely isn't a coincidence. Something is up. And if this is true, then we are heading closer and closer towards bloc politics, where the US will strong arm their allies against China and BRICS. Now, the global majority will definitely hit back. They have the leverage, but oh boy, the entire world will be caught in this gigantic mess. The collateral damage will be breathtaking. More broken supply chains and higher prices for everyone, at least in the US. But let me know what you think. Will countries move more towards the RMB? Does Bessent even have leverage when meeting with China? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.